Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's just dive right in, take a look and see what people are sharing. If you want to follow me, it's at _finance. And if you want to join our community, finding-value.com, where I go over all these topics and sectors looking for potential investment opportunities and sharing it with the community. We have a midweek update that was just released today, so check it out. It's on the website. We also have a special coupon code. Special is the coupon code. If you'd like to join and get a discount on both the monthly and yearly membership. So Porter Stansberry says, so he's responding to this. So this U.S. deficit, revenue, and debt since 1981, you can see it's ballooning to a massive deficit under. It's not really under these presidents. They're just all part of the system, but the system is generating these gigantic debts as we deficit spend. He says you're not voting your way out of this chart because most Americans don't pay any meaningful amount of federal taxes. It's simple math. People continue to vote for more government spending because they believe they won't ever have to pay for those benefits. The quote, rich will pay. The only way to fix this is to vastly broaden the tax base with a fixed flat tax. That might be a 15% VAT, for example, or it could be a flat 20% tax on all sources of income, with only a small personal exemption. But until the average voter understands that all government spending, including Social Security, will lead to higher taxes for them, this problem will only get worse. The deficits will only continue to grow. And I think it's probably already reached critical mass where you can't stop that move. Where we have to print and print and print, and the tax will be a broadly based tax through inflation. It'll be through the currency. So that's their taxing mechanism. So you have to protect yourself as an investor against inflation. That's going to be the big one going forward. Peter Schiff says, today was an unusually strong day for precious metals. Not only was gold up 2%, but silver rose 2.5%. Palladium jumped 4%, and platinum shot up over 5%. A broadening of the precious metals rally indicates rising inflation risks. This is bearish for the dollar and treasuries. I think when platinum outperforms gold, it also signals a shift in market conditions. Market conditions when gold outperforms is a safe haven asset. There's fear in the market. When platinum starts to outperform, that means more inflation is working its way into the system. It's not gold front running that inflation. It's inflation actually getting into the system. It is liquidity. It is money printing. And it's going to show up in the numbers. When platinum outperforms gold, the stock market generally does poorly under that condition, and commodities shoot up. It's a commodity rally that generally occurs. So watch the platinum to gold ratio. Here's bullish trend. API crude is up 2.5 million barrels, but Cushing, gasoline, and distillates have major drawdowns. Usually what I do is I add these all up and see if the number's positive or negative. When you add this up, you get a pretty large negative number. Let's just say it's roughly, let's say about 2 million barrels. A little over 2 million barrels negative, which is a draw. So let's do the exact math. So we got 2.5 positive minus 0.443 minus 3.23 minus 1.4. And you get about 2.5. Yep, minus 2.5 million barrels drawdown of product inventory and oil inventory. So we have a drawdown according to API. Our crude storage estimate for this week's report is minus 3.32 million barrels is what they have for HFI research. So it's a draw is what he sees. And we'll see if that transpires in the EIA data. The Energy Information Agency, or whatever it is, IEA or EAI, however you pronounce it, um, they usually overstate oil. So whatever the number they come out, it's usually a worse number than that. So if they come out with a positive one, we're probably like even. like it, they've been overstating oil for many, many years. In fact, they just went back, recalculated a few years ago, and we're actually running deficits. And they were saying that we were running surpluses. Coming down, another one from Christine Guerrero. She says Permian well permits are down 22% year over year. That's not efficiency gains, folks. That's signaling U.S. oil production decline by end of year, is what she's saying with the permits being down that amount. Permian Basin well permits decline. AI forecast confirms a downward trend. This is the top two gold miners. Total cost jumped over $2,200 in quarter one of 2025. When calculating the adjusted net income breakeven and the free cash flow cost per ounce, Barrick and Newmont's total cost jumped over $2,200 per ounce. And you can see the costs ripping higher here. The gold is the production costs. The gold price is the green. So you can see the green is outpacing the gold, but you got keep in mind we could see inflation in the production of gold, and gold can continue higher, and the miners may or may not increase their margins for this entire bull market. This is with cheap oil prices. What if oil prices go up substantially? That may change the margins of the mining companies. I think by far the least risk way to play this is to buy the physical metals and just sit in it. That's the least risk way. Now, I'd have some mining exposure, but I mean, they are subjected to inflation costs as well, and their production costs are observed as going higher. They're also fighting depletion and declining ore reserves, or ore grades, I mean. The reserves are declining ore grades. So it's harder and harder to get out, and harder being more expensive. Grady says, have you seen platinum and palladium today? Have you seen the big platinum and palladium miners today? As been saying, many will now wake up to platinum and palladium. But go with us. I've played these sectors for decades. We are in from the very lows at the service. So are we. We purchased physical metals and the miners at the bottom. And we are waiting for this bull market to develop and progress, and we'll hold on through the whole thing. Here's another one below the ratio here. He says, if gold is a 5x from here at least, which I think, imagine where platinum will be if this ratio goes back to all-time highs, which I think it will. This blue mega pattern looks ready now, finally. Platinum has a very, very long way to go, as posted, but what the exact final target price will be is not really important right now. What is important is to get ready and to get the best daily guidance along with the journey. Even before I called the commodities bear market low back in 2020 in real time, I said platinum will outperform gold and silver in the coming bull, pioneering platinum case here on FinTwit. As said for those last 5 years now, do make use of what will be the greatest commodities bull market ever seen. It will absolutely be your greatest market opportunity in your life. Agreed. And that's exactly, I bought some here. Now, this is in a ratio format, so gold went up and platinum just traded sideways. So you couldn't get a cheaper platinum price, but you could swap gold into platinum at a pretty good price down here from a ratio perspective. This is probably going to be the bottom of the bottom, is my guess. Part-time trader says, I'm not the only one looking for this move, and he's got a bearish forecast for SPY and QQQ, and he's showing the QQQ chart below. And really what he says is we have a breakout of the upward trend line, and then we're retesting the uptrend line, and we could potentially roll over and break lower into potentially a very big downtrend move. I see a lot of charts showing this, and this is just one of the examples that is showing here. We could see a downward move in the S&P 500. Now, I don't see it in the charts yet, the big bearish engulfing, but it could show up at any time. And usually, just to keep in mind, usually the biggest moves occur very early in this, like the big breakout that we saw. That came from the Liberation Day or whatever it is. And then you get a smaller up move, and then it rolls over. And it may not be as fast. It may be a slow grind lower. So don't expect like a crash. I mean, it could happen in a crash style, but sometimes they end up being like a grind lower. And the way that it moves may or may not impact commodities. If it goes really fast, you could get margin calls. If it goes really slow, you may not get those margin calls. People have time to react and move. Eric Yoon says the next step is Hong Kong pension funds and MPF buying physical gold as their compulsory asset allocation. That should slap the HK milkshake simps so hard that their heads will spin 180 degrees. So he thinks a lot of people could be shifting asset allocation to gold, causing this milkshake crap to break apart. To not be correct, put it that way. Luke Groman says in real oil terms, U.S. debt is not the safest bet on earth. Gold to oil ratio, the blue line, versus long-term U.S. Treasury futures divided by oil ratio in the red. Since 2008, U.S. gold or U.S. GFC and Russia oil resumed reserving gold. Oil exporting and oil importing U.S. creditors lost oil purchasing power, reserving United States Treasuries post-COVID. So here's 2008 post-COVID moving on up. Now, I think Luke says that he expects gold to outperform oil. And really what you're saying is that we're going into a stagflation environment, maybe. But oil is more sensitive to inflation than gold is, historically. So that's a tough call. I'm in the camp that oil is going to outperform gold. We were in a fear safe haven environment where we had a market slowdown, I think, from 2022 onward till probably here today. And I think we could see things shift. I think this could come back down. But again, I could be wrong. We'll see what happens. I'm in the oil bull camp for what's coming, and I think platinum will outperform gold too at some point here. High Heat says, oil pricing controlled with financial oppression, as you know. Recent IEA admission of rigging supply demand numbers should have sent oil soaring. And that's in response to Luke Groman. I think oil is held down to some degree, and we'll see. We'll see what happens. I'm in the camp that when you get these ratios to blow out to one side, where a specific asset becomes incredibly cheap, I don't wait. I just buy it and I accumulate it over time and I wait. And then people make up narratives. They'll say, oh, well, oil's never going to beat gold again. It's at this ridiculously high level. I disagree. It's every time in history we've got to levels above 30 to 1, 30 barrels of oil to 1 ounce of gold. Oil was a great bet. It was a great bet every single time in history. So you're telling me this time is different? Maybe. Maybe it is. I'm betting that it's not. I'm betting that oil is going to go up against gold for a period of time and get back more towards at least normal levels of a 15 to 1 ratio. And I think even eventually, if oil does have production and supply problems, we're going to go to a ratio well below 10. Do you know how high that will be for oil prices? Given where gold prices are today, that means we go under a 10 to 1 ratio. If oil is at $33 or $3,400 today, it would be $340 a barrel. If gold tomorrow is 4,000 or 5,000, well, that means oil is going to go above $400 or $500 a barrel, and that'll be towards the end of the bull market. I think that oil is going to have problems. So yeah, that's what I think. Parallel systems. People have no clue how close we could be. Sovereign debt is the main collateral for clearinghouses. When bonds crash, collateral is wiped out. Margin calls begin, and so more bonds are sold, crashing prices further. A death spiral until the great taking is triggered, in his potential opinion. So, as it's used as collateral, sovereign debt, if we get a large sell off in debt, which we are, it triggers selling pressure, which triggers margin calls, which triggers more selling pressure, which triggers more margin calls, which triggers more selling pressure. Get what he's trying to say now? Then the people who use sovereign debt as collateral could go belly up because what they own is garbage and going down in value. Here's Ronnie. He says, my thoughts regarding the ECB's article. What does the record price of gold tell us about risk perceptions in financial markets? Well, one, when even the ECB acknowledges gold's growing appeal as a safe haven, it's clear that the slow remonetization of gold is no longer a fringe theory. It's becoming mainstream policy awareness. Two, the ECB now highlights rising gold demand amid geopolitical uncertainty. That aligns seamlessly with our core thesis in the IGWT report. Gold is regaining its monetary relevance, not by decree, but by demand. And three, as trust in fiat frameworks declines, gold quietly resumes its role as the anchor of stability. The ECB's recent remarks show that even central banks are beginning to hedge against the system they help build. It's one big hedge. That's all it is. Gold is. Hedge against everybody. Look at this guy. I love it. It says, this guy and his ilk, or his kind, want to know what you're doing with your life and have control over it. How are you feeling about that? I'm not feeling very good about CBDCs. So what is he saying? He says, in cash, we don't know who's using a $100 bill today. We don't know who is using a $1,000 peso bill today. A key difference with CBDC is the central bank will have absolute control, and we will have the technology to enforce that, aka the big artificial intelligence run is probably going to fuel some of this. CBDCs. I don't want a CBDC. I don't want to be tracked. I don't want anything to do with it. I don't want anything to do with it. The TSX venture is unleashed. We're in a raging precious metals bull market. We are, and we're starting to break out here from the 10-year inverse head and shoulder pattern. Shoulder, head, shoulder. Let's rip it, baby. Let's rip it. That's where I'm at. Giovanni, whatever his last name is, says U.S. shale oil production will flatten out if prices remain where they are now, and will start to decline with oil prices in the $50 per barrel. ConocoPhillips CEO Ryan Lance said on Tuesday. The break-even probability hasn't moved a lot. I think long-term, if we're going to say oil prices in a comfortable range, maybe in the 70s or 65 to 75, we'll still see continued modest growth out of the U.S., Lance added, speaking at the Qatar Economic Forum in Doha. Eric Yoon says, so many milkshake simps and crypto morons. If you're smart and you're positioned in physical gold and silver, that's your edge. That's how you win. The milkshake simps and crypto morons are cannon fodder, in his opinion. So he's saying, go physical. Go get the physical, get out of the system. Everyone else, the milkshake simps stuck in dollars and crypto morons, well, the reason crypto I think is so big is just because of the price moves. everybody runs into it and chases price performance. I think that CBDCs trying to be released by governments are interconnected with Bitcoin. And I think that's where people are getting their bullish sentiment, isn't just by price movements, but some of them say, you know what, they're going to do CBDCs and Bitcoin may be a benefactor. And they want money flows to go into crypto. The governments do. It's a way to absorb capital into an intangible asset. Rock Bottom Entry says massive moves brewing in platinum, palladium, potash, and silver. These segments will outperform. We own the best names in each. I think I own the best names of each. I know all the names. There's not many names in platinum and palladium. There isn't that many names in potash either. And also, urea ammonium nitrate is one that will do better than potash, in my opinion. Lower oil price can't last for long, and this is for Harold Ham. Harold Ham says the cost of supply for oil is at least $75 a barrel. Current low oil prices are reducing drilling activity and future supply. Risk of 100 plus oil if underinvestment persists. Tariffs are dampening the economic outlook, but trade deals will. There we go. Coming down, wheat is ready to rip off its 25-year uptrend. Food inflation is coming. Position in agricultural commodities and fertilizers. Yep, I agree. I think that's a great outlook. Here's another one from Grady. Silver looks shorter term bullish, big picture right here. Silver went below the pink line to backtest 28.50 at the crash lows in April, then moved quickly back up intra-month and closed back above the pink line. Now silver is going sideways in a very tight range last 4 weeks. Note that while sideways last 4 weeks, it is still holding the pink line. Plus, seeing a very, very interesting setup for the weekly cycle right here. We could see a big move up in silver, looks like. And I'm in silver long term, so I'm in it. It doesn't really matter what it does in the short term. Here's another one from Grady. He says, the good times for silver miners are coming. Silver miners have underperformed gold miners for 4 years. But 2020 up move is about to repeat, seeing many arguing that precious metals miners are no good just because they are for periods are lagging the metals. That is not very useful information, and repeating that endlessly shows one does not understand the miners or big picture charting. Just like with the metals, playing miners is all about timing. He talks about the service, says it's imperative to really understand that for markets to even work, most have to be at the wrong end of sentiment view on things at major turns, breakouts, and levels. It's always like that, including all analysts, experts, and services. Think hard about what this really means for what you read and watch, plus the time you spend searching for information and for how you invest and trade. Markets move in phases and trends. We are about to enter a new phase for miners, the fourth since the gold 8-year cycle low as I see it. SILJ versus GDX, and we're about to start ripping higher in SILJ, outperforming GDX. We've got some more information here about, this is kind of about platinum and palladium and stuff like that. So Japan's Honda to scale back on electric vehicles, and they're going to focus on hybrids. Honda Motor said on Tuesday that it was scaling back its investments in electric vehicles given slowing demand and would be focusing on hybrids, now far more in favor with a slew of revamped models. Honda has slashed its planned investment in electrification and software by that year by 30% to 7 trillion yen. It's one of the number of global car brands dialing back EV investments due to the shift in demand in favor of hybrids, and as governments around the world ease timelines to meet emission rules and EV sales targets. More demand for platinum, palladium, and rhodium, as they use catalytic converters and hybrids. In fact, they load them more because in hybrids, the catalytic converters don't get as hot. Interesting indeed, the quiet QE. So breaking, Fed caught quietly bailing out the bond market with a 44 billion injection. No buyers, no problem. The Fed just snapped up billions in treasuries, 8.8 billion in 30-year bonds in a single day, and about 44 billion in a total last week. So why is the Fed quietly buying billions in bonds and hoping nobody notices? QE, and I think that's maybe why things are breaking out in platinum and all these other areas. It's going to be inflationary. Okay, so let's go. It says, repeat after me. The spending will never stop. America is the one-way street to economic collapse. Socialism only works until you run out of other guys' money. It's that simple. Friendly reminder that the bottom 40% of people in America who work pay zero federal income tax. Here's another one from Patrick Karam. He says, big picture outlook. The stock market priced in gold has lost an important rising support trend line in the top pane. Now it's bouncing off horizontal support, but within the confines of broken momentum, the bottom pane. In real terms, it's still not looking good. So we've broken out of the S&P 500 breaking down against gold. We've got a horizontal support line that's left, but momentum's already broken to the downside. This thing is basically done. So we're going to see gold outperform the SPX. We're going to go into a gigantic bull market for commodities like we did every single time. Commodity bull market, commodity bull market, commodity bull market, and we'll get a commodity bull market. It's all in alignment compared to history. Looks great for commodities. Here's natural gas. Get ready to go long soon again for nat gas. And this is what we've got projected for potential 2025 natural gas storage. And that's what I've got for today, guys. So we're going to edit there. Give me a thumb up for the content. Subscribe to the channel. You can subscribe to the website if you'd like. Use the special coupon code. Special is the code. And we've got a Saturday question and answer session coming up at 7 a.m. Mountain Time. All right, guys. We'll catch you next time. This is Finding Value.